Most people work their entire lives all the while putting back money so they can enjoy their retirement comfortably. Nowadays, there are different options as far as retirement plans go, and it is hard to know which one best suits you and your lifestyle. In this video, we're going to take a look at that very problem, and so that you know what is best for you, a traditional or a Roth IRA. Which should you choose? Biggest difference between a Roth IRA and a traditional IRA. The biggest difference between a Roth and a traditional is how and when you get a tax break. Contributions to traditional IRAs are tax deductible, but withdrawals in retirement are taxable. In comparison, contributions to Roth IRAs are not tax deductible, but the withdrawals in retirement are tax-free. What is a traditional IRA? The Individual Retirement Account, or IRA, was created as part of the Employee Retirement Income Security Act of 1974. Its creation reflected the larger trend away from employer pensions as workers started moving around more in their careers and living longer post-retirement. As part of the seismic changes to how Americans retire, employers started opting for the predictable expenses of defined contribution plans like 401ks and 403bs. But not all workers received employer retirement benefits. So the federal government created the IRA as a tax-sheltered way for Americans to save for retirement independent of their jobs. You can open an IRA through your investment broker, just like a regular taxable brokerage account. And like other brokerage accounts, you can pick and choose any investments you like: stocks, bonds, EFTs, mutual funds, commodity funds, and whatever else your hearts desire. Advantage of traditional IRA. As mentioned above, the primary benefit of a traditional IRA is the immediate tax deduction. You can deduct the contribution from your taxable income regarding your IRS tax bill. Most states tax your income based on the Modified Adjusted Gross Income, MAGI, or your federal income tax return. So in most states, contribution to your traditional IRA are also deducted from your state tax return. Not all states operate this way, however, so check with your accountant if you don't know your state's rules. The immediate tax savings can compound over time if you invest them. For example, say you contribute $6,000 to your IRA each year for 30 years. Imagine this saved you $1,500 in income taxes each year, and you took that money and invested it separately for a historical average 10% annual return. At the end of those 30 years, you'd have $246,741 in the separate account, accumulated solely from the tax savings and its returns. And that doesn't include any of the contributions to your IRA. A final tax-related perk for IRA contributions is that you have until April 15th of the following year to decide whether to contribute funds. If you don't know whether you'll end up having funds to contribute in a given year, you can wait and contribute as late as April the following year. The downside of traditional IRAs. Traditional IRAs may sound fantastic, but if that's the case, why don't people throw more money into them? In some cases, they can't. In others, they opt not to, given the restrictions inherent in them. Traditional IRAs have limits. These contribution limits typically rise every year or two to keep pace with inflation. Historically, people over age 70 and a half could no longer contribute to a traditional IRA. However, that changed with the Secure Act of 2019, and the age limit was abolished in 2020. But depending on your income, you may not be able to deduct your contribution from your taxable income. Income limits to deduct the contribution. Before getting into the income limits, it's worth pausing to note that all Americans can contribute to a traditional IRA each year, up to the contribution limit. But above a certain income, the ability to deduct that contribution from your taxable income phases out. Single taxpayers can deduct the full amount of the contribution if they earn up to $65,000 in 2020. Between $65,000 and $75,000, the deduction phases out, and above an income of $75,000, taxpayers can't deduct their contribution. Married taxpayers can deduct their full contribution if they earn less than $104,000. The deduction phases out for couples earning between $104,000 and $124,000, and above $124,000, they can't deduct any of their contributions. Now that we have gone over the most glaring pros and cons of the traditional IRA, let's take a look at the Roth IRA. What is a Roth IRA? A Roth IRA is an individual retirement account to which you contribute after tax dollars. While there are no current year tax benefits, your contributions and earnings can grow tax-free, and you can withdraw them tax and penalty-free after age 59 and a half, and once the account has been open for 5 years. Advantages of having a Roth IRA. Tax-free retirement income. The most obvious difference between a traditional IRA and the Roth is how each account deals with taxes. A traditional IRA offers an upfront tax break. Contributions may be deductible in the year they are made to the account. When you pull money out of a traditional IRA in retirement, you owe income taxes. Better for those you leave behind. Looking to secure the posthumous adoration of your beneficiaries? That's one of the possible benefits of a Roth IRA, too. Unlike money left via traditional IRA or other retirement accounts, such as a 401k, where the requirement to pay taxes on withdrawals passes down to heirs, distributions from an inherited Roth IRA are tax-free. No age limit. With a traditional IRA, investors must stop making contributions when they turn 70.5 years old, at which point they are forced to take distributions and begin paying taxes on that money. The Roth IRA has no required minimum distributions. That means you can live up to 120 without ever tapping your Roth IRA. Plus, anyone with earned income can keep adding to their Roth IRA account regardless of age. For people who are looking for relief from today's tax bills, contributing to a traditional IRA offers a welcome tax deduction that you won't get with a Roth. But taking advantage of the tax break today leaves many of the valuable benefits of the Roth on the table. With the Roth, you have to wait longer for the tax savings payoff, but it's worth it, especially for those who predict their tax rate will be higher later than it is now, because you took care of your tax tab up front, funding the account with post-tax dollars. Remember, Roth contributions are not deductible. As far as the IRS is concerned, its business with you is complete. When you start making withdrawals in retirement, you owe nothing, not even for the earnings on your investments. The money is yours, free and clear. Downside of a Roth IRA. Max contribution is low. The Roth IRA contribution limit is $6,000 in 2021. Unless you are over 50 years of age, then it is $7,000. Traditional IRAs have the same contribution limits. That's not a lot. You'll probably need to invest elsewhere, such as a 401k, to have enough for retirement. A 401k has an annual contribution limit of $19,500 for 2021, $26,000 for those age 50 or older. Roth IRA income limits. Another disadvantage of the Roth IRA is that you can't contribute to one if you make too much money. The limits are based on your modified adjusted gross income, MAGI, and tax filing status. To find your MAGI, start with your adjusted gross income. You can find this on your tax return and add back certain deductions. In general, you can contribute the full amount if your MAGI is below a certain amount. You can make a partial contribution if your MAGI is in the phase-out range. And if your MAGI is too high, you can't contribute at all. Meat and potatoes. The biggest question to ask yourself when trying to decide if a traditional IRA or Roth IRA is best for you, from a tax perspective at least, is when you want your tax benefits, now or after you retire. Remember, Roth IRA contributions aren't deductible, but qualified withdrawals are tax-free. If you're in a relatively low tax bracket now, you're probably going to save more money in the long run with a Roth IRA. But if you're in a moderate to high tax bracket right now and qualify for the traditional IRA tax deduction, the immediate tax savings of the traditional IRA contributions could be the better way to go.